Hello, today we're going to present the Basel Accords. Basel First is an accord between banks focused on credit risk and appropriate risk weighting of assets. It was implemented in 1988 and arose from deliberations by central bankers of major countries during the late 70s and 80s. The implementers include the Group of 10. It consists in a set of minimum capital requirements for banks, published by the Basel Committee on Banking Supervision. The banks are required to report off-balance sheet items, such as letters of credit, unused commitments, and derivatives. These all factor into the risk-weighted assets, which are reported to regulators. Now, let's get to know the major objectives of the accord. First, secure international convergence of supervisory regulations governing the capital adequacy of international banks. Second, serve to strengthen the soundness and stability of the international banking system. Third, diminish the competitive inequality among international banks. As the Basel Accord states minimum standards to be achieved, the national authorities can freely set higher levels.
Now I'm going to present the Basel II. It was created in 2004 by Basel Committee on Banking Supervision. This was due to the high number of bankruptcies of large companies and financial institutions in the 90s due to their risk operations. Basel II introduced the concept of operational risk into the calculation of regulatory capital, along with the market and credit risks. With a more flexible approach, Basel II sought to strengthen the standards established in the first agreement, improving banking supervision's practice. At the same time, the agreement offered greater autonomy to financial institutions, allowing the capital limits to be adjusted according to the rules of each central bank, facilitating adaptations to the realities of different countries.
Pillars of Basel II. The first pillar of Basel II is the minimum capital requirement. It defines the bank must maintain enough regulatory capital to cover the main risks they face, which are credit risk, market risk, and operational risk, with the aim of ensuring the solvency of financial institutions. The second pillar of Basel II is the banking supervision process. Its aim to entertain banks, in addition to meeting minimal capital requirements, have sound in an international process and assess and manage their risks. The third pillar of Basel II is the market discipline. It's to promote transparency by requiring banks to disclose detailed information about their financial situation and the risks they face. The aim is to allow investors, customers, and other stakeholders to make the informed assessment and banks' financial health.
Now about the Basel III Accord, it emerged as a response to the vulnerabilities presented during the subprime financial crisis, which affected all over the globe in 2008. It comes to complement the previous agreements. Increasing the regulations on the financial system, stricter limits were determined for the operation of institutions and banks, reinforcing the capital's quality and quantity, aiming that expanding the capacity of the financial institutions would make possible to absorb unexpected losses as a result of economic or financial problems, and in this manner reduce risks of future complications to expand from the financial sector to the economic sector of the economy.
Between the main changes are the reformulation of the capital structure, inclusion of requirements regarding liquid risk with the liquid coverage ratio in the short term and net funding ratio in the long terms, the introduction of the leverage ratio, and the introduction of mechanisms reducing pro-cyclic behavior in the banking systems known as counter-cyclical capital buffer as well as regulatory arbitration. Thanks for listening, everyone.